Okay, so what we're going to be doing, we will be tonight. We're going to do performance management. Okay, just so you know, this week is we're not going to have a lesson for the next 2 weeks. Why? Because we're running the CTA tests. So then when we run CTA tests, we don't have undergrad classes. I like what I did with the Mac 3702 class. I'm going to do with you guys as well, where you're going to do a question that we have covered so far. So in the 2 weeks, you will do one of the exam question papers, not the full paper. I'll tell you which one and which question. You attempt it as far as you can, and and you should attempt it as if you are attempting it in the exam, meaning not under time pressure, but rather how you'd submit your exam. You must submit it to me, so I want to see like whatever workings you do and so forth. No workings on the back of an envelope, no workings on the back of a paper. That is not how you're going to submit in the exam. Whatever workings you will submit in the exam, you submit to me, so I can, because that's going to help me to see your way of thinking and so forth. Okay, so you'll have the 2 weeks to do it. I'll tell you which questions. It will definitely be a direct costing question. It will be a direct costing, variable costing. So a costing question in terms of variable absorption. Um, and it will most likely be a CVP type question, and it will be, but I'll tell you which ones, and that will give us a good gauge as to where we are in terms of what we've covered so far. When we come back after the 2 weeks, we're gonna go a bit harder, so that by the end of May we are done with all topics, and that the month of June, like we're going to do in Mac 3702, is just a revision of past papers. We almost likely cover two past papers with you, and I would want you to cover 1 to 2 more past papers on your own. And in that way, you'll be able to pick up where there are gaps. I'll also tell you how I want you to attempt it. So I'm not going to ask you to do 10 question papers. I'm asking you to do 4 in total, 2 with me, 2 on your own. And why? Because it's going to be a little bit more rigorous than how you normally tackle. So I'm going to ask you for some extra work on those question papers that you do, other than answering the particular question. So that's going to help us to actually get through the exam. So if I think about it, last what we in June, yeah. So last year October there around, also had about 10 people in total for undergrad. That is Mac 372, Mac 3701 combined. Um, and I think 8 or 9 out of the 10 passed Mac 371, Mac 3702. So either 8 or 9, whoever attended the classes fully, I'm talking about those who attended the classes fully, um, 8 or 9 out of them, I cannot remember exactly if it's 8 or 9, but out of the 10, 8 or 9 of them passed, right? Some of them did very well, actually. So I know like my brother actually did quite well. Um, but I asked him, what did he do? How come? It was quite surprising. So I think he got quite a good mark. And it was basically because, I don't know, how you attempt the exams, if whether you write online, whether you actually use PC, or whether you write with your hand. So he obviously did it with Excel and so forth, and he had templates already. He kept his templates. You know, so when a question came in, he had his templates ready, and he just basically plugged and play based on the scenario. You understand, and that helped him a lot. There was no need to memorize anything in terms of memorize formats. There were formats. He knew how to use the formats, but it helped him a lot. And I don't even think he finished the entire paper, but he still got a good mark. So those type of stuff you want to think about. I don't know how you're going to write, whether you're going to whether you're going to write with your hand, or whether you're going to use Excel or whatever. So you might just think about that. Um, so if you really follow the process that we do, right, it's rigorous, yet it's not overthinking. So you must find that balance between the rigorous training and overthinking. If you if you go a bit a notch too much, where you basically um, where you're basically hanging on the side of overthinking, then it's going to be very difficult, because overthinking means you unnecessarily complicating the scenario. So we want to get that fine balance right. Okay, so that's what we're gonna do when we come to July. I mean to June. But for May, we're gonna finish all the theory like we're gonna do tonight with applying a question. Okay. I just want to ask quickly, Alvina, are you also writing June, July?
Sorry, Faiz.
Yeah.
Yes, I want to attempt it.
Okay. So I mean, you're not required to write in June or July
No, I am registered under the early because
program,
I only have this
this
module.
module.
I only have this module. Yes,
Okay.
to
Uh,
complete my degree. So yeah.
yeah. So then we're gonna push for that, so that like in June we will be quite rigorous. We will probably have 4 lessons in June. So when we have that 4 lessons, it will probably be longer than 2 hours, probably 2.5 hours. Because what we do is we're going to
Okay.
do 50 marks, 50 marks. So remember, question paper is 100 marks. So we do one a half a paper, or we do one paper over 2 lessons. And if you go back and then
Mm-hmm.
revise, and you attempt a new question, it's going to work out really well. But let's get into tonight's lesson. Tonight we're going to do performance management. I know this is a topic that many people struggle with. So performance management and transfer pricing. We're not going to do transfer pricing tonight, but for performance management, it tends to be a topic that many struggle with. So let's understand what is the purpose of performance management. We're not going to go into the hectic nitty gritty of performance management. When you come to CTA, you'll probably need to know a little bit more of the technicalities and theories behind it. But on a high level, the whole purpose of performance management is to analyze the performance of two things. So you're going to have to distinguish, based on the question, which are the two things um, you are analyzing from a performance perspective. So number one, you can either be measuring the performance of the manager or of the division. Okay, so you must distinguish between the two. Are you analyzing the performance of the manager, or are you analyzing the performance of the division? If you're analyzing the performance of the division, you need to take every single cost into account that is specific to the division. So if a cost will be incurred, whether or not the division is still operating, then that means that cost is not specific to the division. It is so you only when you analyze a division, you take every single cost into account, but only every cost, every revenue that is specific to that division. So, for example, many divisions will incur a cost that is a head office expense. So head office is allocating some of the expenses to the different divisions. When that division closed down, that head office cost is not going to disappear. It's still going to be there. So therefore, that head office cost is not part of your analysis. Okay, so that is very important to understand. That is from a division perspective. When you look at the pay from a manager perspective, and this is the typical one you're going to get, when you have to evaluate the performance of the manager, you are interested in every revenue, every cost, every asset, every liability that the manager controls. If he does not control the decisions regarding that revenue and that expense, or that asset and that liability, then you cannot include it when you analyze his performance, because it makes sense. How can you judge him on something he have no say on? You can only judge him based on what he is responsible for, what he controls. Okay, so that's important to take note. Now, in some questions, they're going to tell you directly this is what he controls, this is what he does not control. In other questions, they're not going to be as direct. They're going to give it to you in a story, but it will be quite clear whether he controls something or whether he does not control something. It will be very clear, but it will be within a story. So just take note of that. Okay. Now, the two measures that we use to evaluate the performance of a manager or just a performance in general, whether it's a division or it is the manager. There's three that you need to generally test. There's typically two, but you need to test three. So number one, it is contribution margin. So we all know what contribution margin is: sales minus total variable costs. Remember, total variable cost, that is variable manufacturing costs as well as variable non-manufacturing costs. Okay, that is one of the methods. It's not a typical method, but I have seen it in a UNISA exam in the past. We may come across it, I don't know, but just be aware. The typical two approaches, though, number one is the return on investment, ROI. And then number two, it is RI, residual income. Okay, so those are the two methods that you must be able to calculate. You must know the advantages and you must also know the disadvantages, the benefits and the non-benefits of using those methods. So, what is the formula for return on investment? When you evaluate the performance of a division or the manager using return on investment, the formula is as follows: ROI, return on investment, equals controllable profit divided by controllable net investments. Okay, so controllable profit divided by controllable net investments. So that's very important. The word controllable is important because for the manager, you only take into account those income and expenses that gives you the profit that he controls, that he or she is responsible for. Similarly, you only include assets and liabilities that he or she is responsible for, that he or she has control over. Now, we all know what is profit. Profit is revenue minus costs. Net investments, you must be very careful. Net investments is equal to total assets minus current liabilities. Total assets minus current liabilities. But remember, it is only the total assets that he controls. It is only the current liabilities that he controls. Similarly, in the profit figure, revenue minus cost, it is only the revenue that he controls, the cost that he controls. Okay, so that's very important. You can't judge him on something that he is not responsible for, that he has no decision-making power over. So just take note of that. Return on investment gives you a percentage. Okay, so that is the benefit of the return on investment. It's very easy for many managers to understand because generally they're going to have a target. Their target is going to be, let's say, 20%. So when they work out return on investment gives them a percentage so they can see whether they are meeting their target or not. Okay, that's the benefit of it. The disadvantage of ROI is that it's easily you can manipulate it very easily. It is based on accounting numbers. It's not based on cash flow. So you're not really comparing your return relative to the cost of finance, but rather based on revenue versus profits versus net assets. The profit number can be manipulated. The net asset number can be manipulated very easily. So that is the problem with ROI. But the advantage, very easy to understand. It's a percentage, so you know whether you're making the target or you're not making target. So from a CTA point of view, they'll ask you discussion on this. So you might be able to discuss it on a CTA level, or when you go to CTA, especially CTA 2, on the disadvantages and so forth. But we won't get into that now. Then we have RI, residual income. RI, residual income. So residual income equals controllable profit minus, open bracket, WACC multiplied by controllable net investments. Okay, close bracket. So what is that formula saying? You're having controllable profit, you have a number, and then you're saying minus WACC times controllable investments. The WACC is your cost of finance. So when you say controllable investments multiplied by the cost of finance, it's telling you, so the profit shows you your annual return, whereas the WACC times controllable investments shows you the cost of making the investment. So when the return on the investment exceeds the cost, you are making a profit. If the cost is exceeding the profit, you'll be making a loss. So the benefit of RI is comparing your return relative to a correct cost amount. So it's comparing to the WACC. Okay, so that's important. That's the benefit of it, which is much more useful. The disadvantage is that it's difficult to understand. You're going to get a RAND number, 1 million RAND, negative 2 million RAND, whatever. But management is not going to understand what does it mean. They're not, because they can't compare it to the target of 10% or 15%. They just see a RAND number. So it's very difficult to interpret and understand. So that is why that's the disadvantage of it. Okay. But RI is the more superior. Why? Because you're comparing the profit figure to the actual cost of finance, which is the WACC rate. So that's very important to take note. So that's the high level when it comes to performance management. Like I said, it can become quite complex when they ask you a discussion question on it. Because there's quite a bit of, although not a lot of theory regarding it, but it's something big in the real world as to how you evaluate management performance. Because remember, the way you evaluate someone's performance, you are basically telling them how you want them to operate. So, if you are giving them a weak measure of performance, you will end up getting a weak measure of actual returns for your business. So, it's very important how you measure. That is why in the real world, many companies don't have one measure. They have a combination of things so that they get to the point that they want the manager. They want to ensure that they align the manager's goals with that of the company. So that is very important. So think about it this way. With the ROI, we said you can manipulate it, right? Because remember, the ROI can be manipulated. It's an accounting number. If you look at the formula, it says controllable profit divided by controllable net investments. Now, there may come a situation where management needs to decide whether to buy a new machine or not. Now, remember, buying a new machine is buying an asset. That means it is going to impact the net investment amount. Okay. So if you buy a new machine, let's say it costs 10 million Rand. When you add that 10 million Rand to the denominator, it makes the denominator bigger. With a bigger denominator, the actual answer becomes smaller. So that discourages management from actually going ahead to buy the new machine. Why? Because it's going to impact their performance. So what do? They stick with that old machine that has been depreciated over a number of years, because now that machine's price, the machine's value in your net asset, in your net investment number is small. Because remember, you're bringing it in at carrying value. Carrying value is cost minus accumulated depreciation. So therefore, that number is smaller. So it discourages a management to actually make an investment. You are causing management to think short term as opposed to as opposed to encouraging them to think long term. So that is one of the major problems of the return on investment. How you can manipulate it because of if you just look at the return on investment, that will cause a problem. Management is going to make short-term decisions at the detriment of the long term. So that is a huge problem. So it's a well-known aspect. So obviously there's going to be ways that companies will mitigate it. How they mitigate it, I don't know. I haven't seen it, but there's certainly ways they can mitigate it. Either so there's another formula that you actually impact when you do this whole what you call it. But we're not going to get into it. But what I just want to point out why the ROI is not a great measure. Okay, so that's why, like I said, there's many aspects that companies use to mitigate. So they factor in various aspects. Like I remember when I was still studying, I read an article, I think, on how Warren Buffett incentivized his management. Sorry. So the way he incentivized these managers was 75% was based on 75% was based on their own company, and 25% was based on the performance of the other manager's company. Why? Because he didn't want them to work against each other. He wanted them to work with each other. So how did he do it? By incentivizing each other to work with each other. You understand? So that is what when you do performance management, you must be very, very careful as to how you set performance so that it actually encourages. That is why with they give you shares in a company, especially with top management, because they want you to think long term. Long term thinking will help you to actually work in a manner that will push the share price up. Because remember, the higher the share price, the better for you. But on top of that, to ensure that management don't do it in a short term basis, they make it over like a 5 year period. So you need to make sure, at least for 5 years, you are building the company to a point where the share price will remain solid. You understand? So that's how they incentivize management. So just keep that in mind. But we're not going to get into more detail. But like I said, this is not a simple topic, very light on theory, but that little theory is quite deep. But for undergrad, not so important. When you come to CTA, you may come across a complex question. I've definitely seen it at UCT. I've definitely seen it like with students from the University of Pretoria. They have quite hectic questions, like 50 mark, 100 markers on a performance management question. So, but for our purposes, nothing hectic. So now we're going into the scenario that I sent you. If you can open up that email that I sent you, go to question 2. I'm going to give you 5 minutes to read it. Yeah.
Faiz,
Yes.
you said that there was 3 different ways to
Contribution margin.
there was 3 different methods. You
Contribution.
said contribution margin, return on investment, and residual income. Now, what are the benefits and the disadvantages with contribution margin?
So contribution margin is hardly something that is really used, right? I only the two methods, the real methods, basically the two ROI and RI. I'm just mentioning contribution margin because it was
performance management
before in a UNISA exam. Okay, so they have brought it up before. But remember, contribution margin is basically just the like I'll have to think. I can't now think off my hand, offhand now, what is the benefits, disadvantages of that from a performance management point of view. Okay. But if you can open up that question paper that I sent you, you go to question 2. All I want you to read, I think, is one page. It will see performance management. Then just read the scenario. So read the introduction. It's like a few lines, the beginning of question 2, and then you read the performance management, which is one page. I'll give you 5 minutes, and then we're going to go through it together, and then we'll tackle the question. Okay. So give me a tissue in the meantime. I'll be back now. Okay, so let's go through it and then we will cover the question. uh, so I'll share my screen with you quickly. So we're just going to read this performance management section on one page, but I want to read just the introduction of the scenario. Just that under question 2. So they say, what is this? Whatever. Pampulo Milling is a maize milling company in the Rustenburg area of the Northwest Province. The company is 100% owned by the Bumbalo Family Trust, established by Mr. Farmer Braun, a sole representative of the trust on Bumbalo's management team. The milling site is well situated as the company can easily access maize corn from the farming community of both Gauteng and the Northwest provinces. The company uses the direct costing method for inventory valuation. So when you see direct costing, you must know the cost of inventory. The cost of a product is made up of direct material, direct labor, and variable manufacturing overheads. If it was the absorption costing method, then the cost of inventory or the cost of a product would be direct material, direct labor, variable manufacturing overheads, and fixed manufacturing overheads. So that's just the difference between the two systems. Okay, so that's just an overview of the question. Now I'm going to go to the performance management. So I'm going to read it just one page. So they say Mr. Farmer Braun and the management team have decided to expand the operations by investing in an animal feed processing plant. The plant will produce animal feed for the livestock industry. To maintain consistency across the group, the performance of this plant manager will also be measured on the basis of return on investment. Based on this performance measurement technique, Bambulo's manager are entitled to receive a bonus if they meet or exceed the target return on investment. The newly appointed animal feed processing plant manager, Cabello, has, however, raised concerns about the fairness of the performance management system currently in place. Okay, so they may ask you for some disadvantages, inputs, and so forth. The following information has been gathered with regard to the proposed operational expansion. Number 1. Cabello was appointed at an annual cost to the company of $550. He will take full management responsibility of the plant's operations, long-term investment decisions, human resources, and the procurement functions. So now, what you will have to see, anything that falls under human resources, anything that falls under plant operations, so meaning making money, any cost involved, any revenue made, and then long-term investment decisions as well as procurement functions, anything that falls in those categories, any costs, any revenue, he will have to be judged on those. Okay. Remember, so now the question is, should you include his cost of 550? Probably not, because remember, he's not really responsible for his costs. He negotiated, obviously, but who finally makes the decision? The management team. Okay, so you won't include his cost when it comes to evaluating his performance, because his costs got nothing to do with his performance. He has no control over it. The management, his line manager and so forth, his bosses, they have control over his costs. Okay, so just keep that in mind. So what you do in management accounting, every item they give you, you must include in your workings. But when amount is not relevant, like that 550, if you believe it's not relevant, you show it as 0 and you tell them why you're excluding it. Okay, so you will tell him, you will say the reason for excluding it is that the 550 he does not control. That is in the control of the bosses. Okay, so therefore you don't include it in his performance evaluation. So now you're going to have to pick up in the remainder of the points whether something is plant operations, whether something is long-term investments, whether something is human resources, whether something is procurement. If it is, you must evaluate him on it. If it's not, you will not evaluate him on it. Okay. So the new processing machinery will be bought at a cost of 7.2 million rand. So what you notice, a new machinery is a long-term investment. So that will be included in his evaluation. The machinery will have an initial processing capacity of 150 tons per month. All the tons processed will be sold. The estimated useful life of this machine is 10 years from the date of purchase. So therefore, the depreciation relating to this machine must be taken into account in the profit calculation, because he controlled the long-term investment. As a result, the depreciation relating to that investment, it's his responsibility. Animal feed specialists will be hired.
Faiz,
Yes.
Faiz, can I ask a question quickly?
Sure.
Okay, you said that there's two types of decisions, the vision and the management, right?
Mm. Yes.
Okay. Now, why are we basing Kabilo on his assessment rather than the manager's assessment? Why is Kabilo, why are we doing it? Why are we evaluating his performance as not being in his control, but why are we evaluating his side of the analysis and not his managers?
No, we're going to have a look what we must evaluate. Okay. So we will have a look what we have to evaluate. I already read the required. So I know we're going to be evaluating Cabello. Okay.
Oh,
so
gotcha.
But we have to have a look when we come to the required. Okay. But
Okay, cool.
just the stuff
Sorry
of,
for
type of
interrupting.
stuff you will have to think about as you read the scenario. Okay. So number 3, animal feed specialists will be hired at an annual cost of 300,000 Rand. The specialist will be responsible for the entire animal feed production process. So once again, this animal feed is part of the plant operations. As a result, that 300, Cabello is responsible for human resources. So therefore, that 300,000 Rand will be a controllable cost. You will take it into account if you must evaluate Cabello. In addition to the already available delivery trucks, the company will invest in a 3-ton truck that costs 350,000 Rand. This truck will be used 60% in the animal feed processing plant and 40% in the milling plant. The truck will have an estimated useful life of 5 years. So the company is buying the truck, not the plant machinery, not the plant division, not Capello's division. So therefore, we will not still bother taking it into account. Okay, it's a head office cost. If we had to evaluate the division, then we don't take into account 60%. But because we're going to be evaluating Cabello, Cabello didn't take out this truck. The company did. So therefore, it's not his responsibility. Okay, so it's very important to pick this up. Okay, so animal feed, direct material. Animal feeds direct material, which is chop, will either be purchased from the milling site or from external suppliers. At the moment, the purchase price per ton of chop in the market is 6,900. Additional direct material required will cost 300 Rand per ton. Okay, so that is what we additional direct. Okay. So just keep that in mind. What we're going to have to do over here, he's responsible for plant operations. So therefore, we're going to take those costs into account. Remember, okay, we'll come to that now. Number 6, Bambulo will appoint 3 full-time general workers to work at the plant at a monthly total cost of the company of 6,500 Rand each. Variable manufacturing overheads cost per ton will be 400 Rand. And then other fixed manufacturing overheads, excluding depreciation, related only to the animal feed processing plant, will be 50,000 Rand per month. He's responsible for that. The company's annual target return is 20%. The financing of the machinery and the truck will also be arranged by Mbumbolo's management team. The initial indication that the interest rate per annum is 13%. So you can understand that the financing is not in control of Cabello. It is in the control of the management team. So therefore, we can't evaluate Cabello on the financing. Then they say animal feed will be sold to the retailers at a selling price of 9,900 and the related selling cost per ton will be 15 Rand. Okay, so there we go. Now, we will use this to answer part C. So they say, on the basis of return on investment, determine if an animal feed processing plant manager will receive a bonus or not. Show all your workings on an annual basis. Okay, so now we need to evaluate whether Cabello will receive a bonus. How do we know if he will receive a bonus? If his return on investment is equal to or exceed the target return. The target return is 20%. Okay, if you so here they told us the target return is 20%. I think in point 10, in point 9, they told you the target return is 20%. Okay, so that is what we'll have to achieve. So now let's answer this question. I'm going to open up Excel quickly, so just give me 2 minutes. Excel takes a bit long to open for some other reason. Okay, so remember they're asking us to calculate return on investment. So ROI equals controllable profit divided by controllable net investments. Okay, so therefore we need controllable profit we need controllable net investment, and that will give us ROI. Okay, so that's going to give us the ROI we are looking for. So ROI is going to equal controllable profit divided, okay, we'll do that at the end. Okay. Can you see Excel?
No. No, we can't see it.
Okay, I'm going to give him a share it now. You should see it now.
Yes.
Okay. So now we will have a look. Okay. Okay, so now let's work out controllable profit. Okay, so controllable profit, we only take into account that which he can control. So remember, it's going to be revenue, and it's going to be all the different costs, which will equal to controllable profit. So now we go line by line. So now I'm going to go through it line by line. Controllable profit. So now we can go through the line by line. So if we go to point number 1, what I'm also going to do, I'm going to immediately put in a calculation for net investments, controllable net investments. So working to controllable net investments, it will be assets, the different assets, which will end up being controllable net investments. Okay. So as we go point 1, point 2, we will plug in both places. Okay, so let's have a look. In point number 1, they said Capello was appointed at an annual cost of 550. He will take full management responsibilities of all of those areas. Okay, so now we're going to make mention the 550. So over here, Capello's salary, I'm going to put it in at 0. Okay, so now I'm going to tell them why. So why I'm going to put it in at 0? Capello's salary is determined by the management team. Therefore, Capello do not control. Okay, you don't have to write so long, but just for our purposes, you're going to say salary determined by management team. Then I will understand why you're putting it as 0. Okay. So remember, in financial management, in Mac, any number that is given to you and you don't use it, you must tell them why you're not using it. Okay. So you're happy with that? Why are we not taking in Capello's 550? Because we are evaluating Capello's performance. Capello has no power over his salary. He may be able to negotiate, but ultimately it is the management team that will decide how much he gets paid. So he does not have any real control over his salary. So therefore, we put it in at 0. Then number 2, new processing machinery will be bought at a cost of 7.2 million. The machinery will have an initial processing capacity of 150 tons. So remember, all the tons will be sold. So that 150 tons is what the machine will be able to produce. And that 150 tons is what we're going to generate revenue from. So just take note of that. The estimated useful life of this machine is 10 years from the date of purchase. So if we go to number 2, there's 3 things you must take note in number 2. It is the cost of the investment of the machine, the depreciation of the machine, and the tons. The tons we're going to use whenever they talk about a cost per ton, a selling price per ton. Okay, so just keep that in mind. So now I'm going to go for number 2, the machine. I think it was machine, it is 7.2 million. Okay. Then it's also the depreciation. So the depreciation on the machine is going to affect my costs. Depreciation on machine. And remember, it is 7.2 million. 1, 2, 3. 1, 2, 3. Divided by 10 years to get an annual depreciation amount. Why do we take it into account? Because Capello controls it. Capello is responsible for long-term investment decisions. So therefore, we need to take it into account when we evaluate his performance. Don't forget, we must still take the 150 tons, but then 150 tons per month times 12 months will give us our annual tons. Then we will use that wherever they talk about tons, okay? Number 3, an animal feed specialist will be hired at an annual cost of 300,000 Rand. The specialist will be responsible for the entire animal feed production process. So we're hiring someone for Capello's division. Capello is responsible for human resources. Therefore, we will take it into account. Animal feed specialist. Animal feed specialist. So it's minus 300,000 Rand. Okay, so remember, it's a cost. We must take it into account because Capello is responsible for human resources function. As a result, we need to take it into account when evaluating his performance. Then that was number 3. Now number 4, in addition to the already available delivery trucks, the company will invest in a 3-ton truck at a cost of 350. The truck will be used 60% in the animal feed processing plant and 40% in the milling site. So what you must know, Capello is not buying the truck. The company is buying the truck. As a result, we will not factor that 60% of the truck in Capello's performance because he's not responsible for it. However, if we had to do this maybe from even from a division point of view, we will not take it into account. Because remember, if the division is no longer there, the company is still going to incur the costs, okay, incur the depreciation. So therefore, because head office is incurring it, the company, we don't take it into account. So what we will put in over here, delivery truck, and we'll put it in at 0, and we'll say why. Okay, company cost not controlled by Capello, okay, or the manager. That was number 4. Number 5, animal feed direct material will either be purchased from the milling site or from external suppliers. At the moment, the purchase price per ton, okay, so the purchase price per ton of chop in the market is 6,900. Now, every month, we're having 150. But remember, we're working on an annual basis. So it's 150 tons times 12 months times 6,900 Rand. And then additional direct material, it is going to be 300 Rand per ton. So here we can go, direct material, chop. It's a cost, so it's negative. It is 6,900 Rand per ton. Each month, there's 150 tons that we got from number 3. But we're working on an annual basis, so we multiply by 12. Okay? So here we can just say 6,900 multiplied by 150 multiplied by 12. Then other additional direct material. Additional direct material. That's a cost, so it is 300 Rand per ton. There's 150 tons per month. There's 12 months in a year. Okay, and why we just say 300 times 150 times 12. So why are we taking this into account? The direct material and the additional direct material, that is part of the operations of the animal feed process. Capello is responsible for the operations. So therefore, we will factor it into his performance. That was number 5. Number 6, Umbula will appoint 3 full-time general workers to work at the plant at a monthly cost of, at a total cost of 6,500 Rand, a monthly total cost of 6,500 Rand each. Okay, so remember, they're going to work at this plant. Capello is responsible for human resources. So therefore, we will factor into his his performance. So general workers, it's a cost 6,500 Rand per month. There's 12 months in the year and there's 3 of them. Okay, so 6,500 times 12 times 3. So remember, Cabello is responsible for human resources. That's why we're taking it into account. Variable manufacturing overheads cost per ton will be 400 Rand. So variable manufacturing overheads. So why are we taking it into account? Cabello is responsible for operations. Manufacturing is part of operations. So therefore, we will take it into account. So it's equal to, it's a cost, so it's negative, 400 Rand per ton, 150 tons per month. There's 12 months in the year. 400 times 150 times 12. Then the other fixed manufacturing overheads, excluding depreciation, we already factored in depreciation, 50,000 Rand per month. So fixed manufacturing overheads, Cabello is responsible for this. This is part of his operations, manufacturing overheads. It is equal as a cost, so it is 50,000 Rand, and it's per month, so we multiply it by 12. Okay. The company's target return is 20%, what we are looking for. The financing of the machinery and truck will be arranged by Bumbulo's management. The initial indicators that the interest rate per annum will be 13%. So you can just say financing costs. So we put in here financing costs. We'll make it at 0. Why? Because financing is done by management. So because it's done by management, Cabello is not responsible for it. So he does not have control over it. As a result, we cannot take it into account when we evaluate Cabello's performance. Okay.
Faiz,
Yes.
Isn't it a fixed manufacturing overheads included in direct costing method?
So direct cost is only direct material, direct labor. Indirect cost is your manufacturing overheads, and your manufacturing overheads is made up of fixed and variable.
Okay.
So
how come there's fixed manufacturing overheads included in the cost?
Okay, we're not working out the cost of a product. We're working out the profit number. If you're working out the cost of
what needs to be deducted and what needs to be included.
Yes. So when you're working out the cost of a product, then you only apply direct costing system. Here we are using we're working on the profit number. So that is why.
Okay.
Then we have number 11. Animal feed will be sold to the retailers at a selling price of 99 per ton, and the related selling cost per ton will be 15 Rand. Okay. So if we go to revenue, it's an income, so it's 9,900 per ton. Each month we have 150 tons, and there are 12 months. Okay, so we say so this is 99 times 150 times 12. Okay, so if I just add in a line above here, selling costs, it is 15 Rand per ton. So it is 15 Rand per ton. There's 150 tons per month, and there are 12 months. So this is 15 times 150 times 12. So if we add this up, we will see if he's making a profit. So he is making a profit. There's no, so there is total assets. If we put in current assets, I was going to show current assets, current liabilities. I'm just putting it in for completeness purposes. You don't have to do this in the exam because they don't mention current assets. They don't mention current liabilities. It is zero. Okay, I'm just doing it just for completeness purposes. So you must understand that controllable investments is total assets, long-term assets plus current assets minus current liabilities. They know they don't mention current assets, they don't mention current liabilities. So therefore, there's nothing. You don't have to include current assets and current liabilities. I'm only doing it to for completeness purposes. Okay, so therefore, if we have a look at this, so we go over here, this is equal to C, what was it? C29. Nope, C23. Yeah, and this is equal to C29. So I'll tell them working 1, working 2, so return on investment, controllable profit divided by controllable investment multiplied by 100. It gives me a percentage. Okay, maybe I'll take that away. I do that. There we go. So okay, you can see it is exceeding. So you can say ROI of plant exceeds target ROI of 20%. Therefore, Cabello will receive a bonus. So that's basically it. Another, the solution may have input the workings over here, controllable profit over here, controllable investments over here. I like to keep it clean. I like to keep it clean where I just have controllable profit one number, controllable investments one number, and I have the workings somewhere else. You can decide. I prefer my way. Obviously, I'm going to prefer my way because for me personally, it's just much more cleaner and easier to follow. Okay. Doesn't matter how you want to set it out. There's no right or wrong way. Okay, but that's basically how we attempt ROI, controllable profit divided by controllable investments. Okay, just so you know, the same numbers you will use when you do RI, but with RI, residual income, just as a side, residual income is equal to controllable profit minus WACC times controllable net investments. Okay, so what you do, we have controllable profit, we have controllable net investments. You'll just have to get the whatever the WACC rate is. They'll give you the WACC rate. Okay, so either WACC, cost of capital, or required rate of return. So required rate of return, WACC, cost of capital, same terminology. Then you can just input it over here to get residual income. Okay, just so for you to know. So if residual income is positive, then it's a good thing. If residual income is negative, then it is a negative thing. You had a question, Danielle? Oh. Okay, so that's all from my side I wanted to cover for tonight. Is there any questions that you guys have? Alvina, any questions? Danielle? No. Okay, so what I want from you guys, okay? I'll send it in an email also by the end of the weekend. So next week and the following week. So the next 2 weeks, no classes. Then when we come back, we're gonna complete. Okay. What I want you guys to do is question 2, A and B. Okay, question 2, A and B. So question 2, A and B is 24 marks. Okay, yeah, that's fine. I may find some more questions, but for now, A and B. Okay, so I'll send an email as well to all of you guys so you guys know. But if you can attempt that, that will be great. Okay, so I'll see you in 2 weeks' time. Then we're going to continue with some more. Then we're going to, by the end of May, we'll be done with, formal classes like these classes covering all the major topics. And then in the month of June, I'll cover 2 exam question papers with you, and then I'm going to ask you to do 2 more on your own, and then some further analysis what I want you to do. So like just as an example, like part of the things I'm going to ask you to do, we must physically write it out, is let's say you do 27, this is May, June 2017. Let's say we have October, November 2017, and we do those 2 papers. Then I'm going to ask you to compare the similarities between the 2 papers and the differences. You will never believe, just do those type of comparisons will improve your understanding significantly, because now you're questioning yourself, and you actually causing your brain to think further than just doing a question. So that is very important for me, because that is going to ensure that you are questioning yourselves and making the necessary connections between different questions. And that's going to improve your understanding of a topic significantly. It's also going to help you to understand requirements. It's also going to help you to understand scenarios. So that is what we're going to do, but that's when we come to June. Okay, if you don't have any questions, then we'll call it a night. I'll upload all the videos by the end of this weekend. Okay. Then you send me the
I
assignments,
have
right?
one question.
Yes. We can ask a question.
Okay, my question, yes, my question is on the website. The videos is not there. So when you say you're gonna upload it, is meaning that the emails that you send us.
Yeah, so but I'm also going to upload it on the website.
Okay,
But some people find it easy to have it on the website.
okay,
So I'll upload it on the website, and I'm also going to send it in the email. I'll send it
okay,
both. Okay.
okay. So what I've done is I did receive an email to say that I haven't been on the site. So I go on the site and then I go look for the videos, because I am more someone that wants to hear someone explain it to me. Because of my intensiveness of work, I would say, when I come at night, for reading every time, it's very tiring for me. So if I can have this all the time, I will go back to it. It will make things easier for me. So that's why I go onto the website, I don't see it there, then I just go off again, because I really don't want to read all that stuff.
Okay.
To tell you the honest truth. So I prefer classes like this, or even if I can just hear the person
Okay. Yeah.
um uh telling it to me, it's okay. You understand?
Okay.
But not for me to read it, that is like additional strain that I'm putting
Okay.
on
No,
me. Okay.
so
Got it.
I will
Okay.
upload it on what you call it. I'll upload these classes on the website as well. Okay. So by the end of the
Okay.
weekend, I'll have it
Okay.
uploaded as well as send out an email. Okay. Okay. Cool.
Okay.
Any other questions?
Thank
Thank you,
you.
Faiz.
My pleasure. Bye bye.
See you. Bye.
Bye. Bye, Vina. Bye.
Bye bye. Bye bye, Daniel.